Good afternoon. Today we are learning everything about double entry bookkeeping and posting in a ledger.
To have some motivation about the topic we are going to learn today, let us indulge this quote from Henry David Thoreau.
Wealth is the ability to fully experience life.
Now, are your minds ready to learn more about double entry bookkeeping and posting in a ledger?
Makes me wonder, why do we need to study these topics anyway?
Here are some reasons why.
Accuracy,
Error reduction.
Leaving an audit trail,
Financial statement preparation.
Now you may wonder, what about the importance of posting in a ledger?
The following are the benefits of posting a ledger.
Figuring of profit or loss.
knowing the definite situation of an account.
Imperative.
Time saver.
So now, are you ready to really know everything about bookkeeping?
If yes, keep on listening.
Let us start off with the basics of what is double entry bookkeeping.
Double entry bookkeeping in accounting is a system of bookkeeping so named because every entry to an account requires a corresponding and opposite entry to a different account. In double entry accounting, any transaction in one account requires an equal and opposite entry in another account. For managing a business, it is just as important. In the double entry bookkeeping system, you will record two entries for each transaction, a debit and a credit.
We've been talking about ledgers for a while now, but we don't even know what a ledger is. Don't you worry, I always got you. General ledger is a record used to sort and summarize business transactions. Always remember that in writing a ledger, debit and credit must always stay balanced.
They are equal but opposite entries. If they don't balance, your books and financial statements will be inaccurate. Now that you know what a ledger is, what information can be obtained with this? It provides the necessary information to create financial statements like your business balance sheet, cash flow statement, and income statement. In turn, your financial statements can give you a clear snapshot of your business's finances.
When it comes to 5 main account types in a general ledger, we have the following. First, revenue. These are payments made to the business by customers for the goods and/or services provided by the business. Second, owner's equity. The theoretical value of the business that would be distributed to the owners after the assets were sold and the liabilities paid. Third, expenses. Costs incurred by the business in providing the goods and/or services purchased by the customers. Fourth, liabilities. Monies that the business owes to the non-owners. And lastly, assets. Items of financial value that the business controls or owns for the purpose of producing income for the owners.
After knowing about the general ledger, let us talk about the accounting cycle. The accounting cycle is a series of steps used by an accounting department to document and report a company's financial transactions. The cycle follows financial transactions from when they occur to how they affect financial documents. The accounting cycle happens every accounting period or reporting period for which financial documents are prepared.
The accounting cycle begins with transactions and ends with completed financial statements. The first step is to journalize the transaction. The journal is a chronological list of each accounting transaction. After journal entries are made, the next step would be posting the entries into a ledger. Posting refers to the process of transferring entries in the journal into the accounts in the ledger. Posting to the ledger is the classifying phase of accounting. An accounting ledger refers to a book that consists of all accounts used by the company. the debits and the credits under each account, and the resulting balances.
While the journal is known as books of original entry, the ledger is known as books of final entry. Once all journal entries are posted, the ledger balances are posted to a trial balance, which is a list of all the accounts and balances, checking to see that the total of the debit column is equal to the total of the credit column. Each account is then checked for accuracy and adjusted, if needed to be, before the financial statements are run. This process is referred to as the accounting cycle.
To keep your records accurate, you should post to the general ledger as you make transactions. At the end of each period, transfer journal entries into your ledger. Use your ledger to classify and organize transactions. When posting entries to the ledger, move each journal entry into an individual account. The accounts, called T-counts, organize your debits and credits for each account. There's a T account for each category in your accounting journal.
Transfer the debit and credit amounts from your journal to your ledger account. Your journal entries act like a set of instructions. When posting journal entries to your general ledger, do not change information. For example, if you debit an account in a journal entry, debit the same account in your ledger.
Keep in mind that your general ledger lists all the transactions in a single account. This allows you to know the balance of each account. But to find the balance, you need to do some math. After posting entries to the ledger, calculate the following balances. For the asset and expense accounts, you need to subtract total credits from total debits. For the liabilities, equity, and revenue accounts, you need to subtract the total debits from the total credits.
If you don't want to mess with the calculations yourself, consider investing in accounting software. With accounting software, you can record transactions in your ledger and the software handles the calculations for you.
If you're a little lost, don't stress. Instead, follow these steps to post journal entries to the general ledger. Number 1. Create journal entries. Number 2. Make sure debits and credits are equal in your journal entries. Number 3. Move each journal entry to its individual account in the ledger. For example, checking account. Number 4. Use the same debits and credits and do not change any information. And finally, number 5, calculate the account balances in your general ledger.
So why are ledger entries so important? It keeps you organized, makes it easier to find transactions, compartmentalize transactions, let you see the big picture of your company's financial health, show you patterns in income and expenses, helps you catch accounting mistakes in your records. Keeping your ledger up to date can help you avoid penalties and ensure that your records give you an accurate picture of your business's finances. Have you learned a lot from today's lesson? Make sure to leave a like and a comment below. Please subscribe for more lessons like this.